For businesses that have inventory, you then must discover what is the cash conversion cycle of the business. One of the components has to do with inventory, and there's a formula for the cash conversion cycle, and that is the days the inventory is outstanding plus days the sales are outstanding minus the days payables are outstanding. So what is days inventory outstanding? That is the amount of days that the inventory is sitting on your shelves. Now, if you're selling something like fine wine, you want a long inventory cycle, but for most products, you don't want products sitting on the shelf. So you may see a large number on the balance sheet for inventory, and you may see an inventory report listing all of these items, but how long have they been in inventory, and what are the chances that they will actually ever sell? So the days the inventory outstanding is very important. The days the sales are outstanding is exactly what it sounds like. Once you have sold the inventory, how long does it take to get paid? The longer, obviously, the worse that the days the sales outstanding value actually means. And then what you'll have to do is add in the days payables are outstanding. Now, the days payables outstanding are how long you are paying your suppliers. And you actually want this to be longer, because the longer that you are taking to pay your payables, as long as you're within terms, the better, because that means you're holding on to cash longer. So 2 examples. Company A has a days of inventory outstanding of 30. They have a days of sales outstanding of 15 days, meaning they get paid 15 days after they sell the inventory. That's a total of 45, but because they have supplier credit with 60-day terms, you take the 45 days minus the 60, they have a negative 15-day cash conversion cycle. That is good. Company B has 45 days of days inventory outstanding, meaning the average time their inventory is on the shelves is 45 days, compared to 30 in example A. They also have 30 days that have 45 days that their days sales are outstanding. So after they've sold inventory, it takes them 45 days to get paid, compared to Company A, which gets paid in 15 days. And finally, the days payable outstanding is 30 days. So we have DIO of 45 plus DSO of 45, that's 90, minus the days payable of 30, that's 60 days. Their cash conversion cycle is 60 days. Company A had a negative 15-day cash conversion cycle. So when doing a quality of earnings, Company A is much stronger for a buyer and for lending purposes.